wasting money on cures. Forgot how to fix myself. They say that time is free. Then why is it so precious? Oh, I'll say memories in my head, like Polaroids on walls. They remind you to look ahead. Time is running out. Time is running out. Lately I've lost my track. I've sailed the deepest seas, hoping to find something to bring back better times. Oh, I'll say memories in my head, like Polaroids on walls. They remind you to look ahead. But time is running out. 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 Time is running. Time is running out. But time is running out. What if my best days are over? They can't be over. They can't be over now. Time is running out. What if my best days are over? They can't be over now. Time is running out. Time is running out. Time is running out.
Evening, everyone. It's Jim here. Let's unmute the mic. Welcome to the latest in our series of live revision sessions for AQA A-Level Business. Just me tonight. Graham is on his way from Newcastle in time, hopefully for the EdXL session, 7 o'clock. And whilst we're talking about being on the road, just a quick reminder that we are now up and running with our Grade Booster workshops. So we were enjoying our visits to Newcastle on Thursday and Friday last week. And this week coming up, we're in Manchester, AQA on Tuesday, EdXL Wednesday, and then Leeds, AQA Thursday, EdXL Friday, before we move on to Bristol and Birmingham the following weeks. If you can join us for those, that would be great. Okay, so let's take a look at our warm-up activity. Let's get this on the screen here. As always, we start with the warm-up activity in PowerPoint just as people are joining the session. Have a go in the live stream, in the live chat if you're joining me live. Who is going to be first to get the correct answer? Have a go. You can have as many goes as you want, by the way, just like the real exam. This business was founded in 1987 in South Africa. So if you're sat there thinking, well, I know a business that was founded in 1987, but it was in New Zealand, it's not that one. What do we think? Have a go in the live chat. I'll keep an eye out on the live chat, as well as trying to keep all these buttons moving. Second clue, still privately owned by a family, the same family who founded the business back in 1987. So let's have a look. The next clue, I wonder whether I might beat on this one. I suspect the fifth clue will give it away. Now has global sales of over £1 billion across over 30 countries. So it's a genuine multinational business. Not bad for a privately owned family business set up, what, just over 30 years ago, 35 years ago, wasn't it? Fourth clue, its signature product is marinated for 24 hours. No less, no more. And the last clue is, no one's got it yet. The last clue is Ed Sheeran is rumoured to have a black card which gives him unlimited dishes from the menu. What do we think? That last clue might have given it away, or maybe not. Maybe I've beaten you. It's very rare that we beat the live stream audience. Tonight could be the night. There was me thinking we'd beaten the audience. We haven't. Charlie was the first in with the correct answer. Sam was pretty close afterwards. Maddie was very close as well. But I'll give it to Charlie on this occasion. It is indeed Nando's. Excellent stuff. Right, so as always in these sessions, we write some new exam standard MCQs. And tonight is no different. So here's our first one. I'll give you a clue on these. The answer is either always A, B, C, or D. Never anything else. And these aren't easy, so hopefully these will be useful. All on Unit 3.5, Financial Management. So a business is charged a much higher interest rate on its long-term borrowings, bank loans, that kind of stuff. Which measure of profit is going to be directly impacted by this change? One of those four. Much higher interest rate. Sounds like it's a highly geared business there. One of those, and one only, will be directly impacted by the change. What do we think? Leona and Freya, Sam and others are, and JT Galaxy, welcome back, are indeed going for what I believe to be the correct answer. Let's have a look. It is indeed C. Yep, profit for the year. So why is it not gross profit? Well, interest isn't part of cost of sales, and neither is interest costs an operating cost. Interest cost is a finance cost that comes right at the bottom of the statement of comprehensive income. The gross profit margin, clearly not impacted because gross profit isn't impacted. So yeah, well done. Now you need to know three different measures of profit and the specification: gross profit, profit from operations, and profit for the year. Off to a good start. Well done. Here's our first two-statement question. Might be the only one tonight, actually. I'd be foolish to guess if there's another one. So this one is on receivables and payables days. So as always, let's work out whether each of those statements is true or false, and then select the answer from the options given to you. So a decrease in the receivables days ratio indicates that on average, customers are paying a business quicker, true or false? And what about statement 2? A decrease in the payables days ratio indicates that on average, a business is paying its suppliers slower. What do we think? Lots of people having a go on this. Good to see. Not everyone has gone for the same answer. Lots of people taking their time on this. You should always take your time on MCQs, particularly these two-statement questions. We want to make sure we get every mark. A number of people posting the same letter in multiple times. They only get 1 mark, but it is indeed B. It's true. Let's just go through why that is. If you thought, maybe you're watching on demand, you thought it might have been a different letter. Well, receivables days ratio tells us how long on average it takes our customers to pay us. Customers who are given trade credit. And well, if the receivables days ratio is falling, that means that they are paying quicker. So that's good news for the business. Payables days is how long on average we take to pay our suppliers. So if that's falling, actually we're paying people quicker, not slower. So that's why it's false. So well done if you said B. Let's have a go at this next question. A business sells £100,000. I should say £100,000, not 10,000. That should say £100,000 of its trade receivables to a debt factoring company for £80,000. So it's got 100,000 of trade receivables. It sells them to a debt factoring business for £80,000. What's the effect on the business? Is it some combination of higher or lower cash balances and higher and lower profit? Have a go. So £100,000 of trade receivables, the business decides to sell those for £80,000. What's the effects? Give you a few seconds to think about this one. Don't forget, when an amount is shown in trade receivables, that means we've made the sale. So hopefully we've earned the profit. Well, we will have earned the profit on that sale. And indeed, most people are going for the correct answer. So well done, Maddie, JT, Ella, and others who went for C. Well, obviously, higher cash balances. We are swapping trade receivables for cash, £80,000. So it might be lower, but it is still swapping an amount that's owed by a customer to some cash in the bank. However, the cost of that is that we lose £20,000, don't we? The debt factoring company buys £100,000 worth of trade receivables for 80, and it will hope to recover all of those trade receivables so that it can make a profit of £20,000. But our business loses some profit from that transaction. Oh, we did actually have another two-statement question. So we've got two more MCQs. Here's one on crowdfunding and share capital. So crowdfunding always involves a business giving a shareholding to those who invest. Is that true or false? And the issue of new share capital, does that decrease the value of capital employed in a company? What do we think? These are, I would say, quite demanding, quite tricky questions. So if you're sat there thinking, I'm not quite sure about some of these, I think this is as hard as it gets. But worth going through them. Lots of crowdfunding, for example, can be examined for the first time in May and June. It's a new topic on the specification. Never been in the specification before. And actually, not surprisingly on this one, a number of people are going for different answers, a mixture of A's, B's, C's and D's. Let's have a look at the answer. It is D. Both are false. Crowdfunding, let's deal with that one. That is false. It doesn't always involve giving shareholding away. Sometimes it does, but often it doesn't. Crowdfunding, for example, can involve giving investors a percentage off the price, or first access or first use of a new product or service. Don't necessarily get a shareholding in the business. There are lots of different incentives that you can offer in return for finance raised from the crowd. So that's false. And similarly, an increase in share capital, well, that increases the amount of capital employed in a company, doesn't it? It means that we've raised new capital. Therefore, our capital and reserves goes up. Our cash goes up, hopefully, as well. We've got more finance, more capital invested or employed in the business. So that was indeed false. And we've got one more for you. And actually, I thought we only had one calculation tonight, but actually I've squeezed one into an MCQ. So for you calculation fans, you're going to be really pleased tonight, I can tell. So we've got a closing balance at the end of the year in a cash flow forecast of £260,000. Now, we're told if the opening balance at the start of the year was 25% higher than that, what was the forecast net cash flow for the year? So cash flow forecasting and percentage changes, two of my favourite things. The closing balance in a cash flow forecast was £260,000. We're told the opening balance in the cash flow forecast was 25% higher than the closing balance. So what was the forecast net cash flow? Have a go. I'll take you through the workings on this because it's not, I was going to say it's not easy. It is easy if you know how to do it. And it looks like lots of you do know how to do it. And importantly, you were taking your time to do it accurately. JT, John, Joe, Izzy, Freya, Maddie, lots of others. Tom, well done. The answer is indeed, well, we agree. So hopefully we're all right. It is indeed minus £65,000. In other words, a forecast cash outflow for the year. Let's just go through why that is. Well, we're told the closing balance was 260,000 and that the opening balance was higher, 25% higher. Well, the opening balance must have been £325,000. That's what we started with in our forecast. And by the end of the month, by the end of the year, it's fallen to 260. That's an outflow, a net cash outflow of £65,000 or minus 65,000. Well done. Now that we're in the mood for calculations, why don't we just do a couple more? I won't start the music just yet, so you can have a look at the information on the screen. Two calculations, both of which can be achieved using the information in the table there, which shows some information about the sales and the cost of a business. We're told the selling price per unit. We're told the variable cost per unit. Whenever you see those two things, you should be thinking break-even analysis. We're told the revenues this year. So you might be able to work out how many units were sold this year. And we're told the break-even output. So reverse engineering that data, can you have a go at calculating the fixed costs this year and also the margin of safety this year? So two numbers to have a go at. I'll start the clock, which gives you a minute of funky music to have a go. There's our minute. Just been looking at the stream of answers appearing on the live chat. And I picked out Dan because it looked to me like Dan agreed with my numbers. Not the only one. Maddie has also gone with the same numbers as Dan. Fixed cost of 180,000 and a margin of safety of 3,250 units. Well, if Dan and Maddie both think that, there must be a pretty good chance that that is the right answer. Shall we have a look? A number of you are still having a go at that, so that's no problem. Don't forget, if you're watching this on replay, pause this video, give yourself as long as you want on this. This could easily be 3 markers here, 6 marks. And firstly, fixed costs. Well, we were told the break-even output, weren't we? And we remember our key formula, the break-even output, 18,750 units, is fixed cost divided by contribution per unit. Well, we can work out contribution per unit. That's £16 of selling price less the variable cost per unit of £6.40. So it must be £9.60. You know what my maths is like. So therefore, 18,750 units worth of contribution per unit must be our fixed costs, £180,000. And the margin of safety, as a number of people have said in the live chat, is the difference between actual output or actual units sold and our break-even point. Or we can work out actual units sold by dividing revenue, 352,000, by our selling price per unit, so 22,000 units sold. Well, the break-even output was 18,750, so we are higher. We've sold more than the break-even output. Therefore, we are making a profit. Don't forget the magic formula. Profit is contribution per unit times the margin of safety. Now, a number of people have, in the live chat, just written down some definitions and some formula. Don't forget, even if you've got no idea about the calculation, or you don't have time, or you don't want to have a go, hopefully not want to have a go, but don't have a go, just write something. Write what fixed costs are. Write what the margin of safety is. You'll get a mark for knowledge. Don't leave anything blank on AQA A-Level exam papers, particularly when it comes to calculations. Well done. Got a couple of mini case studies for you to have a go at now. No more calculations, just looking at some mini questions, and then we'll actually have a go at a little 9 marks to finish off this session. Here's our first one. So in 2021, online supermarket and technology company Ocado, they raised £500 million of venture capital to invest in its robotic and automation technology. Incredible business. Incredible, not just its warehouses, but all the technology that goes with it. And they needed some extra finance, so they went to venture capital. So thinking about that as a source of finance, can you give me 2 advantages to Ocado of raising finance through venture capital? Have a go, and I'll look in the live chat to see whether 1 or 2 of you have got some thoughts on this. Let's give this a minute. Wow, some fantastic answers coming in, and all of them spot on. Really interesting that you've got fantastic knowledge and understanding. Maddie, amongst others, pointing to an advantage to Ocado of the expertise and the support. It's an interesting feature of venture capital, which if we had more time, we could discuss. But find a good venture capital firm or investor, and you get much more than just cash. And a number of people, Fran and others, have talked about, John Joe and others, stick John Joe's on there, how venture capital investors bring expertise. John Joe also talks about not having to pay interest, which is another relevant advantage. Awesome stuff. Well done. I'm pleased we did that mini case on venture capital. Let's just spend a minute just going through a couple of possible responses to that. In fact, it's exactly, I've just put on the screen what you team have been putting on the live chat. The first one is access to expertise. So venture capital is a source of finance. You get the cash, but it's more than just that. So the right venture capital firm will provide or have detailed industry expertise. They'll have technical advisors. They'll have connections. They'll be able to introduce Ocado to a whole bunch of interesting organizations and people that perhaps they wouldn't otherwise be able to access. And therefore, that could help Ocado accelerate the development of its technology. And that's the important thing, isn't it? It's a technology business. And therefore, maybe help them expand into new online grocery markets, a bit of application there, more effectively and possibly quicker than, say, just getting finance from a bank loan. I mean, I've spent quite a bit of time in venture capital over the years, and I'd rather have investment from venture capital than a bank. No doubt about that at all. And one of the reasons is no interest. Well, yeah, strictly venture capital can also provide debt, but let's not go there. Venture capital, if it's share capital, it doesn't involve debts such as bank loans. Therefore, we don't have to pay significant interest payments each month or each year, as a number of people have mentioned in the live chat. And what a benefit of that to Ocado, it means you've got more cash to invest in the development of the automation technology, perhaps get things done quicker rather than paying interest on the amounts owed if you had debt. Superb answers. Let's see how you get on with this next one. Quite an interesting one on cash flow management. Have a think. Here's our second mini case today, and this one's on sportswear retailer JD Sports. And you may remember, you may not, they experienced some cash flow problems during the pandemic 5 years ago, wasn't it? When its physical stores were forced to close. In response, JD Sports renegotiated longer payment terms with its suppliers. They basically said, we're not going to pay you as quickly as we normally do. So over to you for another minute. Can you give me two potential impacts? So you can either go two positive, two negative, or one each of this approach to cash flow management by JD Sports. Over to you. Wow, again, fantastic answers coming through. And I've just picked out a few John Joes there on the screen, which I'll just mention briefly, and lots more coming through as I look at the live chat. John Joes in particular, because he has used our favourite method of application known as such as seasoning. We'll mention this for the remaining part of this session. What an answer that one is. One impact is that JD Sports will be able to pay for supplies such as Adidas tracksuits over a longer period, allowing the sales to come through before supplies are paid for, thereby improving cash flow. Not content with one amazing point, because I asked for two. John Joe's gone for an alternative point. It may damage the relationships with suppliers, potentially losing the ability to benefit from purchasing economies of scale in the future, albeit in that second point, John Joe has neglected to include some such as seasoning. I'm sure as I speak, it's on its way. Awesome. Well played. Well done. Let's pick a couple more. Yeah, Charlie's making the point. It's improved liquidity. If you take longer to pay, it means you keep the cash for longer, which is true. Freya's making the point, linking it nicely to our efficiency ratios. Payables days figure will increase, therefore better liquidity. If you can keep it there, but a downside potential conflict with suppliers. Looking at fantastic answers coming in. Let's just show you what I went with, which is exactly what you went with. Let's just flick a couple of buttons here. I went with, first of all, one possible impact is damaged supply relations. So JD Sports will be buying sportswear and sports equipment and other stuff from all the major brands. And if they extend their payment terms, force suppliers to wait longer for payment, that potentially creates tension, doesn't it? And that could lead to some problems. For example, a supplier such as, I don't know, Nike, prioritizing suppliers of trainers or sportswear to competitors like Sports Direct. There we go, there's some application. It could increase the lead times, waiting for inventory to arrive in the store, therefore potentially losing sales. Or suppliers may ask JD Sports to actually pay more for inventory, a higher purchase price for items such as hoodies and gym bags. And the second point is a positive thing. It will improve liquidity. So if you delay payments, it means you keep more cash in the business in the short term. Why is that an impact, a benefit? Well, it could be used, as it was in the pandemic, to fund essential payments such as paying the wages of sales assistants and rent on the stores. Obviously, that's not something you can sustain forever. Ultimately, payables days, payment terms with suppliers is a negotiation. And I suspect they've probably paid a little bit quicker once trade started to pick up. Well done, well done, well done. So a couple more activities before we finish. One is a little application spinner. A couple of minutes over to you to give me some application on Breakeven, and then we'll do a quick 9-mark question on your favourite topic, my favourite topic, budgeting. So our application spinner gives you a chance in the live chat to give me an answer that is relevant to the business that appears when we spin the random wheel. And in this case, the question is, how could this business, it's going to be one of those 6, how could this business reduce its break-even output? We're live to the AI Center. No idea where it's going to land. And well, can you believe it? It's landed the same one it landed on last week. Weatherspoons. So how could Weatherspoons reduce its break-even output? So we are looking for application here. We're looking for words. Well, obviously, we're looking for a relevant answer, but we're also looking for words, industry terminology that make it about Weatherspoons, for example, and not about Primark. So if Fran's in there, they could increase the selling price of their drinks or food. Yeah, that would do it. Although you might argue that Cineworld also sells drinks and food, but definitely Weatherspoons does. Charlie went in with increasing the price of pints. Well, Weatherspoons sell pints, so it must be about Weatherspoons. Owen's gone for lowering their fixed costs. That would indeed reduce the break-even output by, for example, reducing staff hours in their pubs. Pubs is application, especially in remote areas that have lower footfall. Footfall, the word footfall is application and shows a sophisticated knowledge of the Weatherspoons industry. Now, Fran, I'm just going to stick this on the screen, and Fran has deliberately put this into the live chat to enable me to help make a point about application, which is that ingredients and cheaper suppliers could be about anything, couldn't it? So the question is ingredients such as what? That's what we're looking for. Last one coming in from Dan. Lots of great answers coming in. It could reduce fixed costs such as the rent on its premises. Yeah, I'll take that. Or reduce variable costs such as switching to a cheaper supplier of beer or snacks. That's what we wanted, beer or snacks. Such as seasoning, the best way to show application. I went with Weatherspoons could reduce its break-even output by increasing the selling prices of its meals or by reducing the cost of wasted ingredients. Waste is often a big issue with food and drink business, particularly food businesses. Reducing the cost of wasted ingredients, making mixed grills or all-day breakfasts. This would increase the contribution of each meal served. Packed full with application. What do we think? Some great ones coming in. I'll just stick JT's on the screen because I think it's even better than mine. Not that that's hard. Weatherspoons could reduce variable costs such as bulk buying cheaper brands of alcohol. Fantastic. Or buying ingredients such as lettuce, tomatoes, etc. for their sandwiches. Cheaper suppliers of lettuce and tomatoes. Love it. Let's do one more. Let's pick 6 different businesses. Same question. You've got the idea now. Let's get some different answers on the screen. So we've got 6 different businesses. Same question. How could this business reduce its break-even output? Now, Wasn't this time last year? Was it last week? So British Airways. So how could British Airways reduce its break-even output? What do you think? Don't forget, we're looking for application. The magic word such as. What do we think? British Airways. For those of you who don't know, British Airways is an airline. Long time since I've flown on British Airways. It's not a low-cost airline, that's for sure. So we're looking for ways in which, don't forget, with break-even output, you can only really do three things, can't you? Or all three. Increase selling prices, of what? Reduce variable costs, of what? Or reduce fixed costs, of what? So Dan said, I put Maddie's in. Dan's answer has been usurped by Maddie, and not surprisingly, because it's an amazing answer, by increasing ticket prices. Not just prices, ticket prices. That's what British Airways sell, isn't it? Tickets. By raising fares, ka-ching, application on popular routes, like long-haul flights to New York, ka-ching, more application, or Dubai, more application. It increases revenue per passenger, improving contribution per unit. That is one of the best pieces of application I think we've ever had on any of these live streams, ever. So embarrassingly, I'll just show you mine. By negotiating lower prices for its fuel, it's an airline, or in-flight meals, maybe even better, or by charging more for baggage, this would increase contribution per passenger flown. But I doff my metaphorical hat to Maddie for that answer, which was just sensational. Absolutely amazing. Well done. Lots of great answers coming in, but like mine, can't even hold a candle to Maddie's answer. That was fantastic. Right, last little activity, and then we'll take a well-earned break. Hopefully it's been useful. Let's just give this 5 minutes, shall we? A 9-mark question. Don't forget, I've just uploaded, I think, 60-odd new 9-mark questions for you to have a go at. I'm not saying they're going to come up, but there will be a lot of 9-mark questions in paper 1 and paper 2. So we've got one here on budgeting. So this year, a restaurant chain recorded a favourable revenue variance, but an adverse profit variance. Analyse a reason why this may have occurred. So if we just unpick that question, it's about variances. So in your answer, you would need to demonstrate knowledge and understanding of what a variance is. You don't need to define a variance, but definitely demonstrate knowledge and understanding. We need to get to how and why a favourable revenue variance might still have ended up as an adverse profit variance. And so is there anything specific we need to think about? Well, we need to know why that occurred. So we have to focus on a possible reason, and a chain of reasoning as to why it have occurred. And how many arguments do we need for this? Well, it's singular, isn't it? So we're asked to analyse a reason. So we don't need 2 paragraphs. You can write 2 if you want, but you're wasting your time. You can get level 3 just by developing 1 relevant point. So over to you. What do you think? Maybe just a few thoughts in the live chat. Give you a minute. I haven't got a funky clicker or timer on this one, but let's maybe just have half a minute thinking about possible lines of analysis that we could use to explain how a favourable revenue variance for a restaurant might have led to an adverse profit variance. And I'll pick out 1 or 2 that are coming into the live chat. Not saying this is the best, but it's definitely one of the first, and Dan's been on fire tonight. The restaurants clearly had an adverse expenditure budget. Yeah, an adverse cost variance. So spending more than they budgeted for. So you've shown me you understand an adverse variance without having to define it, by spending more than they budgeted for. E.g., the cost of ingredients in the restaurant may have risen, such as oil, vegetables, and eggs. Absolutely sensational. Let's have a look. What else have we got here? Freya. It may have occurred because of an unexpected increase in demand for meals, although this means an increase in the cost for supplies. Yeah, so I think the hard bit here is because we're obviously selling more than we're expected, so that picks up on the favourable revenue variance. But why is it that wasn't enough to make as much profit as we're expecting? Because if we're selling more, you might expect to make more profit. Something has gone wrong, hasn't it? Something has gone wrong. Let's have a look. Let's stick Sam. Sam has been prolific today. I don't think we've had enough of Sam's answers on the live stream. Let's have Let's have this one because it's a cracker. This could be because, so this is the point to develop. This could be because the total cost of the business were adverse or high, adverse, i.e. more, we spent more than budget. We just see development to say more than budget, such as wasting food like fruit and vegetables, which means that the variable cost of each meal sold was higher than budget, basically. Higher than budget. Good stuff. Now, obviously, you want to develop any one of those points into a paragraph, 6, 7, 8 lines long, maybe max. Just to hopefully get yourself 7, 8, or 9. Here's my answer. Let's just quickly run through it, see what you think, and then in the live chat, please tell me how many out of 9 would you give this. So, one reason is that actual costs were higher than budget. If the profit variance was adverse, but actual revenues were higher than budget, then it must be that the restaurant also had an adverse cost variance. This may have occurred if restaurant cost of sales, such as the cost of menu ingredients or drinks, were higher than budgeted, or if the restaurant fixed costs, such as leasing cooking equipment or wages of the chefs and waiting staff, were higher than assumed in the budget. So even though sales of meals and drinks were higher than budget, this was not enough to offset the adverse impact on profit of larger than expected key restaurant costs. Mark out of 9, please, in the live chat. What do we think? Does that analyze a reason why a restaurant chain may have recorded a favourable revenue variance but an adverse profit variance? Kovac saying, I thought wages weren't fixed costs. They are really in a restaurant. They are mostly fixed because you have to have the chef. The chef is paid, let's say, 10 hours, whether you sell one meal or none or 100. So the waiting staff, they can be stood around doing nothing, but their cost isn't directly related to how many meals or customers they serve. So unfortunately, in restaurants, a lot, apart from the ingredients, a lot of costs like rent, salaries, that kind of stuff, wages are quite fixed. JT's saying 7 out of 9. Leona's saying, would that be long enough for 9 marks? Yeah, you don't need to be any. You don't, as long as the answer meets the demands of the question. Let's have a look. I have indeed put it to Examiner AI. Here's what it gave it. It gave it 8 out of 9. As we know, and it's something I'm working on this week, Examiner AI struggles to give you 9 out of 9. It doesn't like giving 9 out of 9. Not that it really matters because it's still an A-star mark, but it is indeed a level 3 response. And it gives a nice summary of the analysis. It says it's a logical, well-developed point explaining how higher costs can lead to an adverse profit variance despite increased revenue. The reasoning is clear. Application, yeah, a big tick. The answer effectively applies the concept to the restaurant context, mentioning specific costs such as menu ingredients, equipment leasing and staff wages. The application is relevant and it supports the analysis. And indeed, the answer, AO1, does demonstrate a clear understanding of the concept of revenue and profit variance. So yeah, 8 out of 9. Owen's saying that looks like one paragraph. Is it enough for a top grade? Absolutely. In fact, I think every 9-mark question in paper 1 and paper 2 last year, we don't know what's going to happen this year, was a singular question. You only needed one paragraph to meet the demands of the question. Some, like in paper 2, sometimes you have to give two points, but most 9-markers these days are 1, and therefore, why write more than 1? So that is indeed a level 3 response. I don't think there's any doubt about that, but hopefully you would have written something. I would say my teacher always claims I'm too concise. Haha. Well, the joke's on you, Owen. Well done. Write concisely and relevantly, and the result will be happiness. Excellent stuff. Okay, well done, everyone, and well done to everyone who's had a go. Thanks to Jeff in the live chat moderating role tonight. A number of people at the end of last week's session said, thanks, Jeff. I think they were talking about his work on the live chat rather than me confusing him for me. If you're back with me this time next week, I'll be doing it live from a Premier Inn somewhere. We're on tour next week, 5 days. But I'll make sure that we do a session at 6 o'clock next Sunday. And hopefully, if you've been watching on Catch Up, you found this session useful. As always, you can download the PowerPoint now from the tutortu.net/live website if you want to go through the PowerPoint. Thanks for joining me live. See you next time.